Hello and welcome to an FXTimes daily market recap. I'm CMS Forex market analyst Nick Nassad. Today is Tuesday, January 12th, 2010. Following Monday's session, which saw a bit of risk appetite in the currency markets, today we reversed some of those sentiments as we had a poorer than expected earnings report from Alcoa Inc., a very large aluminum manufacturer. And we also had China's central bank raise its yuan reserve requirements ratio by 50 basis points, which is a move intended to stave off inflation and to put the brakes on the growth seen in the economy. Now, while China's move is just the beginning of a gradual phase in which it becomes more concerned about inflation. That should go at a slow pace as annual inflation is currently running at 0.6% in the country. Still, those two pieces of overnight news caused a bit of a sell-off in European stocks and in commodities, which hurt risk appetite in the overnight trading. We can see that pullback in risk appetite, especially in the Australian dollar US dollar pair. The Aussie has been gaining on positive Chinese data, but after hitting a high yesterday around the 0.9325 area, which lined up very nicely with some old resistance levels we saw in November, we slid in today's session, falling all the way to test at 0.9170 level. So the Aussie did take a big brunt of traders' reaction, as well as we saw some strengthening in the yen. In a look here at the US dollar Japanese yen pair, today's trading saw the pair slide about 150 pips from high to low. If we zoom this pair back a bit, we did have an upward sloping line of support that was cracked in yesterday's session, and we retested that level in our high today, and then we fell further. So taking a look at some other yen pairs, let's take a look at the euro yen. We see a similar story where the yen was a very big benefactor to today's risk aversion. So here we broached our lows that we saw near January 6th with a intraday low today at 131.6. So this was a pretty sharp 200 pip slide in the pair from high to low. The euro-dollar pair, meanwhile, slid in overnight trading following its rise yesterday above the 1.45 level, and it dipped below the 1.45 level throughout most of overnight trading. Then we did have a little surge here up to retest yesterday's high, but for the most part, we remain within the confines of yesterday's trading range. We did have this slide back down to the middle of today's range in late New York trading as New York stocks fell, and the increase in risk aversion helped the greenback to cut its earlier losses. In data from the US, we saw the trade balance for the month of November widen in November, with the deficit posting a 36.4 billion shortfall between exports and imports. While exports did rise by 0.9%, and that put them at the highest level we have seen all year, imports surged 2.6%, mainly as a result of higher oil prices. So the deficit did widen, and it widened by a bigger than expected amount. In the UK, we had a different story in that the trade gap with the rest of the world narrowed by more than expected in November, as we had a small rise in exports of 0.1%, but imports fell 0.8%. So that can help the economy as we have a positive direction in trade. In other data from the UK, we saw the BRC Retail Sales Monitor for the month of December show retail sales up 4.2% on a like-for-like basis from last December. That followed a 1.8% annual increase in November. So in December of 2008, sales had dropped 3.3% due to the turmoil we saw in financial markets and the drop in consumer confidence. So these figures were helped by the comparison with last December's terrible results. Two more reports came out from the UK, and they focused on the housing sector. We had the RICS house price balance for the month of November, and while it showed that 30% of surveyors saw higher prices in homes, this was smaller than the 35% of surveyors who saw higher housing prices in October. So this is a pretty closely watched indicator, and it shows that the housing momentum in the UK market lost some steam in December. The DCLG house price index for the month of November showed that housing prices were up 0.6% on the year, which was a better than expected result, and that was the first time that annual house price inflation has been positive since June of 2008. With that fundamental data from the UK out of the way, let's take a look at the pound-dollar pair, which we saw here. Rose in today's trading, retesting its high from yesterday's session around the 1.6190 level. The gains by the pound did follow the better than expected UK trade balance release, and we'll see if the pair if the market wants to take this pair higher above this resistance level, or if we perhaps move into a bit of a sideways range with support at the 1.6050 area. Zooming this pair out, we do see that this week's trading has broken a bit of a downward resistance trend line that we broke in yesterday's session, and we sort of retested in today's trading, which corresponded with our moving average here too, a 50-period moving average. We're looking at 1-hour candles. So we'll see again if this implies some kind of further pound strength, or if this resistance at 1.62 will hold. In the euro-pound pair, we see that the euro tried to test the high we saw in yesterday's session, but failed to breach that level, and fell in the rest of during the UK session and in New York trade. We fall now to the middle to lower half of this sideways range we've been seeing in the pair, with resistance at that 0.9025 area and support at here around 0.8920. In a final look at some trade data, this time from Canada, we saw that the trade balance there fell into deficit in November, as the shortfall between exports and imports was 300 million Canadian dollars. Exports did rise 1.1%, but imports rose a much stronger 3.9%. The export figure was boosted by a 6.2% increase in the shipments of energy products, and if we took that out, exports had actually done very poorly as a result of a strong Canadian dollar and very weak US demand. Exports of industrial goods and machinery, which led export growth in the previous 2 months, fell 2.5% on the month. So this was a very poor release for Canadian trade sector. That resulted in the Canadian dollar sliding in today's trading, as not only do we have weaker risk appetite, but we also had the weak fundamental factor to go with it. So the greenback has found some support following its dip to the 1.0250 area, and now we are testing resistance at around 1.04. We have a move above it, or if this is going to be an opportunity for traders to buy the Canadian dollar. If we zoom this pair out a bit, we see that our 1.04 level also matches this trend line that we set up if we use the low from November 11th and December 2nd, which we broke in last week's trading, and now we're retesting it. It had acted as support, we broke it, and now we're retesting it as resistance. So this could be an important power line. The fundamental docket is rather light in the upcoming session. Tonight, Japan will post data on machinery tool orders, while overnight we get manufacturing and industrial production data from the UK, as well as industrial production data from the Eurozone. Tomorrow, the US will post its Fed Beige Book, as well as the federal budget balance. Both of those releases come in the New York afternoon session, so trading may be more dependent on how equity markets are faring, as well as technical factors. So that'll do it for today's market recap. For more news, videos, and analysis, please do visit our site at FXTimes.com. Again, I'm CMS Forex Market Analyst Nick Nassad, and I want to thank you for watching.